Good morning, everyone, or good afternoon if you're in the East Coast. Thank you for joining us. Today, we're going to be talking about something everybody loves talking about, taxes. Now is the time to talk about it because we're in the season, and it is something that unfortunately nobody ever gets away from. So I'm going to try to start this correctly. I'm a little bit tech challenged when it comes to this, but I'm hoping you all will bear with me while I get this up and running. Um, and it should be right here. Okay, great. So today's presentation, why your tax bill might be higher in retirement than while working. Seems counterintuitive, right? You're not working anymore. You're making less money. You should be paying fewer taxes. And that's just not the case. It rarely is that you're paying more, but it does happen, especially when you look at a percentage basis, right? Because the taxes that you have with FICA, with payroll, are regressive. The more you make, the more you're going to pay. And for the most part, it's that way too. But there are some flat taxes and there are some backward-looking taxes that you have to worry about when you're retired, that a lot of people don't take the time to think about. So this is one of the reasons why we are decided to have this presentation, especially during the season. Now, we will have questions afterwards if you want to, if you have any. We are going to be able to make this within the 30-minute mark. We do have some material to cover. It's not going to be that complicated, right? Tax is not complicated, but believe me, we're going to just scratch the surface. As anything, with anything we talk about or any time, you do need to reach out to your own advisor, your own planner, to make sure that you know what parts apply to you and what parts don't, right? So the next thing we have to do is we have to do the disclosures, right? I am affiliated with Osaic Wealth, they're a broker dealer. But our advisory accounts, we do through NWF Advisory, independent registered investment advisor. Osaic Wealth is separately owned. And any other marketing names, including Amenity Wealth or NWF, are wholly separate. All right, so what is the common assumption when we come to retirement? Is now most people think, I'm making less, I'm paying less, as I said before, right? And it should result in a lower tax bracket. And for many of us, it does. But the reality is that the reason it's not that simple is because of the different taxation treatments you have for different income flows, right? And that's the main point. When you are working, unless you have, let's say, passive income through real estate or real estate investment trust or investment, you're pretty much set to the federal guidelines, the state guidelines, and you're able to get your standard deduction, right? Unless you're able to deduct, right, or itemize rather. But for most of us, retirement income is stacked. Now, what does that mean? It means it comes from more than one location, right? So for example, Social Security, that's the first big one, right? Social Security is what we all depend on. We've all been paying into it since we've been working. And it's tax-free. So it starts off. It does get taxable pretty quickly. In a later slide, we'll go over how that works. Then the next part is we have the required minimum distributions or RMDs. Now, those hit if you're 73 or older, unless you're born after 1960, in which case it'll be age 75. But mandatory withdrawals happen there, and they're not a small amount, right? They start about 3.7% of your totals when it comes to retirement assets. That means all IRAs, all 401ks, all 403bs, all 457s. The exception, Roth. Roth IRAs or Roth qualified retirement plans do not have an RMD. So that's one of the advantages to having a Roth. Then pensions. For those of us lucky enough to still have a pension, because only about 18% of organizations and companies out there still have a pension. And even that number is an overstatement because it includes companies like Xerox and Boeing that froze their pensions, right? If you were lucky enough to have a pension to begin with them, you haven't had the additions in the last few years. They're just growing by simple interest, right? But those are not taxed the same way that Social Security is taxed. And then lastly, investment income, right? Qualified dividends or your regular dividends, taxed differently. Capital gains, taxed the same way as qualified dividends are. Interest income, taxed the same way non-qualified dividends are, right? And of course, we have tax-free income, which we get from municipal bonds or from life insurance policy cash values. Again, no tax is great, but all different taxation is the reason why we have this confusion, because we're not getting it from a single source. So start with Social Security. Now, the good news is Social Security starts tax-free, but it's really, really easy to get it to start getting taxable, right? Now, and the reason is because they look at your combined income. And I'm going to go into detail a little bit here as to how that works. First, what they do is, depending on your income threshold, it starts at 0. And then you can see on the right-hand side the taxability threshold. Now, to calculate this, you have to get your Social Security number. Let's say it's 30,000, and then you cut it in half, 15 in this case. And then you add any other interest income that you get, right? Which is your whatever you get in, let's say, your CDs or your savings accounts, right? So let's say you get an extra 30,000 from that, right? So we had 30,000 from Social Security. We cut that to 15. We have another 30,000. So that's 45. And let's say you're single, filing jointly. Well, as you can tell, you're already above the $34,000 threshold. Now, 85% is taxable. And as I mentioned, these are low thresholds. If you live in the big city like we do here in Los Angeles or New York or Miami or Atlanta, it's very easy. It's very difficult to actually live a moderate lifestyle, right? Given the cost of living in these metropolitan areas. So, and just to be clear, it's not that they'll take back 50% or 85%. It's just that your Social Security begins in a little breakout box on your 1040 that is non-taxable. As you hit these thresholds, more ends up in the taxable column. And how much you pay there depends on any exemptions, any deductions, anything else that you have, right? So one of the things that can really add up and make Social Security taxable, required minimum distributions. These are always a lot of fun, right? Now, for those of you that don't know it, once you hit age 73, and again, age 75, if you're born after 1960, you have to withdraw a small amount, starts off small amount, of your retirement accounts on an annual basis, right? It starts at 3.77% at age 73. And it starts rising up. It's 3.77, 3.9. By the time you're 80, you're just under 5%. And so what we have here is you have a compounding problem, because people that have been saving, I've seen this happen a lot. Their Social Security and their pension, great, covers most of everything. The IRA or the 401ks, they're a gimme. And they will give you more taxation headaches later down the road, right? People tend to forget about them. Market keeps growing, assets keep growing. And then next thing you know, I'm told I have to withdraw how much? And it's going to affect what? And it's going to affect everything, because the domino effect is that this is extra added income to your adjusted gross income, and it's ordinary. So it's going to push up your level. So is it possible that 1 year Social Security is not taxable and next year it is? Oh yeah, definitely, easily, right? And there are ways to mitigate this, right? One of the ways is early withdrawals. So if you actually are coming up on retirement, you want to start questioning how much you have there, how much you're going to start taking out, whether adding to the 401k or the 403b or 457 makes sense on a traditional basis. And keep in mind, if you don't add to it, you don't get that salary deferral. So there is that trade-off. But if you're going to start withdrawing on it right away, then this is money that you're, going to be taxed on right away. You might look at maybe putting in a Roth 401k if they offer that. If they don't, you also might consider doing a taxable account outside. I'll go into detail later as to why you want to do that. But higher RMDs will affect your tax bill, higher taxation, not just Social Security, but increase Medicare payments, right? IRMA, if you haven't heard of it, stands for Income Related Monthly Adjustment Amount, right? And it's the amount that they take from your Social Security. We're going to cover that in the next slide. But early withdrawals is one way. You can also, if you find yourself up against the wall with a higher RMD, give it to charity, QCD, qualified charitable distribution. You can do a little bit more than 100,000 now to your favorite 501c3. You will still get a 1099, but it will be coded that it was a charitable distribution. And so this way it doesn't hit your income statement. That is one way. And it doesn't have to be an all or nothing thing, right? You can do part charitable, part to yourself, however you want to do it. The thing you can't do is you cannot convert your RMDs to a Roth. That would be really cool and nifty if you could. IRS won't allow that. If you do Roth conversions in retirement while your RMDs are in force, which you still can do, your Roth conversions have to be above and beyond whatever your RMD is, right? So if your RMD is 10,000 and you converted 20,000, they're going to want to see a $30,000 distribution in total, right? Otherwise, penalties, interest, all that fun stuff. So now we get to the Medicare premiums, right? Or what we call, the income-related monthly adjustment amounts. They're income-based. Now, how do they work? Let's say you have a big RMD this year, you're 73. And let's say it is big enough it even bumped you into another bracket, right? For Medicare. The next year, the data is shared, and it's actually 2 years after the event that your premiums adjust, right? So this is one of the greatest sources of tax drag in retirement. Why? Well, because it's not only just on your regular adjusted gross income, but to figure out Medicare premiums, they use modified adjusted gross income. Now, what does that mean? That means they get to figure back in tax-free income, capital gains. So things that had tax-free or really tax advantage treatment, gone. They add it back, they come up with a bigger number, and then they put you in that bucket. Now, the income-related monthly adjustment amount will increase your Parts B and Part D, right? On certain thresholds. Give you an idea what those thresholds are for 2026. The surcharge will begin at 109,000 for single filers. In other words, it starts raising at that point in time, or 218 for joint filers. And it can accelerate. I've seen people that are paying $400 per married person. It says $800 a month per month for their Part B. And it just comes out directly from your Social Security check. So if it's $400 a month and you're getting $1,000 a month, you're only going to see $600 hit your account. There are very few ways to mitigate for this. I will tell you one thing. Here's a little free bit of advice if you're coming up to retirement, right, in the next 6 to 12 months. They also do this when you just are retired. They'll look back like, hey, you were making a pretty penny. Here are your new Medicare premiums. You need to ask them for the form SS44. And what that form is to alert the Social Security Administration that you are going through a major change in life. In this case, you're retiring and you're letting them know, I'm not making this money, right? I was still working. They will adjust it downward. Also, if there's a death or divorce, right? A major life change, that's going to impact your income in an adverse way that will affect your IRMA. You want to alert them to this fact. They won't necessarily play ball, but it's better than just sitting and bearing it, right? So the 2-year lag, it's a one-time spike in income. If your income does go down, then of course it'll go down and readjust that next year. But yeah, I mean, 2 years is a long time to wait. You just notice that, hey, they're taking a lot more out of my Social Security. So again, failure to plan is planning to fail. And we still have to worry about capital gains, right? There are, we still have to do investment sales at times, sometimes just to rebalance. Now, if the rebalancing happens within a tax deferred account, an IRA, Roth or otherwise, right? Or 401k or whatnot, then obviously you're not going to be taxed for this. But if it happens outside and you still want to rebalance if you're having a strategic allocation, then yeah, those are going to be capital gains. And also in a taxable account, dividends, anytime they're declared, whether you reinvest them or take them, you're hit with the taxation, right? And the tax impact is going to depend, right? Even long-term capital gains rates increase the overall, what your overall income for tax calculations. Remember, even if you are in a low tax bracket and pay zero in capital gains, right? Because your tax bracket is low enough, they still take that capital gain, add it on top of your income. Hey, you know what? That could affect your Social Security or your IRMA. And the ripple effects are going to go all the way through. Higher income triggers, Social Security taxation and Medicare premiums. I've seen this a lot too. Many retirees, especially we deal with a lot of people that work at Boeing or Northrop Grumman or SoCal Gas, and they were buying company stock. So now they have a concentrated stock position. That is a lot of risk. Not a lot of risk you want to carry in retirement unless you sit on the board, right? I mean, that's why Warren Buffett can carry that many concentrated positions. When you own X amount of the company, yeah, they'll probably give you a board seat. But unwinding them for retirees can be tricky. And so you're going to want some offset for the capital gains that you likely will experience. And this is where I mentioned starting to build out portfolios outside of a 401k or 403b or retirement account in general, right? Yes, you will still pay taxes on the dividends, right? But the dividends will be qualified if they're American companies, if you held them for at least 60 of the last 121 days, right, since their last dividend. And, that's still taxed a bit better, right? Even though it's assessed right away. For the bond portion, you can do municipal bonds. If they're California bonds, you're a California resident, double tax free. Same thing if you're in Georgia or New York. If you're in Florida or Texas, since they don't have state tax, it actually opens up your universe of possible additions to the portfolio of your municipal bonds. So you can not only diversify across different types, revenues or general obligation bonds or insured or non-insured bonds or AAA rated or double B rated. You can go across states too. Now, again, you have to rebalance these, and you're also going to need some money from spending. But each sale is going to have a taxable event. So this is why strategic timing and the tax loss harvesting that we just were talking about are so critical. Now, the other reason why a lot of people have problems kind of wrapping their mind around why am I paying so much in taxes? So fewer deductions. I mean, for example, a lot of retirees have no more mortgage interest, or they've either paid off their house or they are now in the second half of the amortization schedule, which is more payback of premium. I'm sorry, principal, right? So less interest deduction. The other thing is you don't get the payroll tax deferrals anymore. And those were a lot of prepayments. You have to do a lot of your own figuring out proper withholding when you're retired. Ideally, you want to be in a place where you don't owe anything and you don't get a refund, right? The second best position to be in is you owe something, but your refund, rather you owe something, but the payment is $1,000 or less. Anything more than that, you might get a nasty letter from the IRS saying, hey, unless you buck up and fly straight and fly right, we're going to have you do quarterly filings, right? Which is always a dream come true. Your accountant likes it. There's more paperwork and more fees for him or her. You won't. So this is one of the reasons why you have to be very, very, very thoughtful. And of course, the third case is them sending you money. That's the worst thing you want to do. It does kind of feel like you won the lottery a bit when you get a refund from the IRS. The problem is that means that you weren't efficient enough because they're not going to give you a return on that money. You gave them basically a 0% interest loan, right? And they won't send you a thank you card either. And then lastly, we have the state and local tax limitations. Luckily, these have gone up under the One Big Beautiful Bill Act to 40,000. So they're going to be more impactful for some than others, but still, it's got a hard ceiling there. So, and for those of you that don't pay a lot in state and local taxes, well, then it's all federal. This is a deduction you don't get to take anyway. One thing that's not on this, one deduction that was flown under the wire under the One Big Beautiful Bill Act, is the excess deduction for seniors age 65 plus. So for the next 3 years, you are able to put on top of your standard deduction, which is a little over 15,000 for single filers and over 30,000 for married filing jointly. And you can add 6,000 to the 15, right? Bring you up to a little over 21, or 12,000, which is going to bring you over 42 if you're married filing jointly. That's a hell of a deduction. But it starts phasing out at $75,000 in adjusted gross income for single filers, 150,000 for married filing jointly. Goes down about 6 cents per dollar. And then at $175,000 of income single, it's gone. You don't get it anymore. $250,000 for married filing jointly. So that is, and it's only good for the next 3 years. So if you're thinking of doing Roth conversions in the next few years, see where you fall under this level, because you might want to hold off because the tax savings may outweigh what you're going to end up with in Roth conversions, right? Question becomes, why is this so surprising to so many retirees? Well, the income feels invisible. That's why. I mean, you're not getting a bi-weekly check. You're either getting whatever day of the month Social Security pays you, right? Or the first or the last month, day of the month, if you're getting annuity payments or if you're getting interest income, right? Or RMDs, depending on how you do it, or one fell swoop for the RMDs, which is the way a lot of people do it. So there's different mental accounting that goes on there, right? The other thing is that, as we pointed out, you don't get the same taxation. They come from different locations, so they're taxed differently. Always keep in mind, there's no grand unified theory of taxation. It'd be nice if there were, right? We could sit there and deduct on a more efficient basis what would fly and what wouldn't. But it's just every new administration makes promises. They then push their tax idea through. You know, at the beginning, they usually get it, and then we're dealing with what's left over. And the last part is late planning. The best time to do any of these changes, it's like compound interest. Best time was yesterday. Second best time, today, right? The longer you wait, the more you're going to be leaving money on the table, or the bigger your tax bill is going to be. And keep in mind, none of what we discuss is at all exhaustive, right? There are other, or comprehensive, there are other taxes that you could be subject to depending on your level of wealth. For example, the net income investment tax, or the Medicare surcharge tax, as they call it. That's as high as 3.8% above certain thresholds. So it adds up. So the goal is what? Fewer surprises, right? Have realistic expectations. What I mean by that, you know, I've seen the ads for, and the books, 0% taxation. That's kind of like a unicorn. It doesn't exist, right? Is it possible that you can live so leanly you pay no tax? Sure. And that's like saying you can live to be 100 if you give up everything that makes you want to live to be 100, right? So you will probably pay some taxes. The idea is to mitigate where they come from, you know, how they'll affect you, how they're taxed, and what you can do to offset them, right? So you have to see the connections there. And early planning creates that flexibility. Like I said, best time to do this was yesterday, right? So hopefully what all this will do, what we're trying to accomplish, is to give you some confidence in your retirement. Nobody likes paying taxes. Absolutely nobody does. But there's nothing wrong with tax avoidance, right? Now, mind you, tax avoidance, not tax evasion. Tax avoidance is, I am not going to invest or undertake or do any action that will adversely affect me tax-wise. Totally illegal. IRS doesn't care. Tax evasion is, I am now subject to a tax. I don't want to pay it. No, that's illegal, right? They'll come after you all day, every day. But tax avoidance is exactly what you want to practice when you are retired, right? The more you pay in taxes, the less money that's in your pocket for retirement. So this is one of the reasons why you certainly want to review this ahead of time. If you have 5 years or less to retirement, now's the time to start because, like anything else in life, what gets you there is not what keeps you there. So that does it for our presentation. Let me see. Yeah. So I'm going to see if we have any questions from anybody. Well, seems like we don't. So if anybody does have any questions, of course, you can always reach out to me, boris.castillo@amenitywealth.com. If you didn't get that, you can always go to the Amenity Wealth website, find me there. I'm on LinkedIn, I'm on Facebook, I'm on Twitter, but keep in mind that these are things that you do have to get in front of because once it has happened, once the realization event has occurred, that's it. There are no do-overs, there are no gimmies, right? The tax is now assessed and it's going to be charged, right? So in the meantime, I wish you all the very best of luck in this year's tax season. Hopefully, some of the One Big Beautiful Bill Act provisions will be something that will positively affect you. And as always, if you have any questions or you want to look over any strategies, please feel free to reach out. Thanks, and thank you for joining.